Hi, hello everyone. Welcome to ICM Academy. So this is Sai Mahesh with you. Hope everyone doing well. Good to see everyone. And today we are going to see about like an introduction to technical analysis. It's all about ways about like technical factors which affect markets. So before we begin today, let's move on to a small brief about ICM. So ICM has been established in 2009 in UK. So we have a brand with multiple regulations, with offering many products, currencies, commodities, stocks, indexes, futures, and cryptos as well. And we also provide a platform like MT4, MT5, CTrader, and we also have provided ICM securities as our other platforms. So quite interesting part is like we are, as you know, that we are completely has a different regulation from different country zone. So, and we also have a local regulations in different areas focusing from UK. And before I begin the webinar, I'd like to inform that all the opinions and analyses and news and information mentioned in this webinar is only serve for educational purpose and should not be taken as a signal whether to buy or to sell on a certain financial instrument. So usually ICM does not provide any kind of investment advice. All right. So let's begin our topic today. And this webinar will be recorded and will be uploaded in YouTube. Later, if you like to want to visit or want to have a look on it, definitely you can have a look. So let's start our things today. What is technical analysis? So basically, technical analysis is one of the factors which affect the markets. So obviously, traders or beginners will completely know about the two kind of factors which really affect the markets. One is the technicals, one is the fundamentals. So today topic where we are going to cover a basic about the technical factors, which really helps you for the people who are into trading or beginners mostly to like to know what is technical, how exactly to read the technicals, what are parameters or what are the features that are available in the technicals, so which will help you to do that. So technical analysis is a study of price movements in a market whereby traders make use of historical chart patterns or indicators in order to predict the future trends in the markets. So basically, it is usual representatives of past and present performance of the markets and allow the trader to use that information in the form of price actions, indicators, there are patterns to guide them to inform the future trends before entering to the trade. So really, there are two type of traders are there in the markets, both the technical traders or the fundamental traders. So this technical analysis beginners guide will be introduce you to basic about trading approach and how it can be used to trade in the financial markets. That's what exactly we're going to see today. So traders make use of historical data or based on primarily on price of volumes, use of informations, identifying the trading opportunity based on the common patterns or indicators or signals, something like that, which help you. So major benefits of this technique analysis is that can be applied to any of the markets or any of the time frame. It can be applied for even for the lower time frame from the 5 minutes to higher time frame for weekly and monthly as well. So this technical analysis can be also used as a standalone methods. Obviously, like many traders are use this technicals as a main source of indication and signal. They take the call on the markets and allow the trader to identify the trends in the market. That's what exactly. So this technique analysis is a method of forecasting a direction of price through the study of past market data, primarily price and volumes. So traders will examine the odds of showing the price performance instruments like based on the forecast or future price of past. So that's what exactly it is all about. So covering the topics in technical analysis today, where we're going to talk about what is technical analysis and type of charts, what is there in the technical analysis, support and resistance, which also helps you to define what are the levels are there in the day wise or weekly or daily wise, retracements, and also we're going to see some couple of few patterns, important patterns. So I'm not going to get bored on this because there's a very basic things, and it's also help you for beginners as well as for intermediate traders, which will help you to more improvise their kind of knowledge in the technical. charts, right? So let's move on to this type of charts. So I've taken here as only the major types. There are like 5, 6 types of charts are there, but usually traders willing to easy to identify the trends, easy to read it out, which are the 3 type of charts. So one is like we can say it's a line charts. So one is second one is a bar chart. The third one is the candlestick charts. It's quite interesting one because when you start reading, understanding about the charts, what exactly it is, because in this topic we are going to learn about what define the charts, how it built, what are going to different type of chart it is. So in this technical analysis, like how who trade exclusively on the chart, basically I'm talking about who want to trade only in charts, use the charts to be analyzed in various type of securities as well as a forecasting the market as well. Although techniques can be used graph almost exclusively to use the charts in a limited way of technical analysis. This can also be a great and fundamental analysis, helps them to also to move the markets along with the technical information. So this is what exactly the all about. So once the time frame which you're using on this technical analysis with a line or bar or candlesticks, it all depends on your way of how you read the market, what kind of strategy you are following in the markets. It should help you to do that. So let's move on to the line chart first. So, all right. So first line chart. So line chart is include one piece of trading information. That means like, which is usually the closing price of the particular time frame. For example, you kept talking about the 1 hour time frame. So what is the closing happens? So each and every closings, for example, I have plotted here a daily chart here. So this is on a daily basis. Each and every day close and has been marked as a point and has been drawn as a graph. So some market players who trade on daily or not on intra-daily base consider as a closing price to be on the open, high, close parameters, because intraday swings can be ignored in this, because as you know that it's a closing price has been defined. So it is similar way scatter plot expected that the measurement points are ordered. Typically it's a y-axis. X-axis value, the joint as a straight in the segments. So basically, all the points we can see here, it is all which is the closing price of the particular day of the markets. So which has been drawn accordingly. So line chart is often used to visualize the trend in data over intervals of time. So with this line chart, many traders are there or experienced traders are there who try to take a trend lines or trend channels or something like that to identify the trends, which really helps them. So this is all about a basic about line charts. So when talking about the bar chart, so it's one of the most popular charting method in bar chart. I mean, in order to each period of the bar chart is being plotted, you will need to have high, low, open, and close, basically, right? So I'm going to explain to you how exactly to read the bar chart. It's quite interesting compared to the line chart. High, low are visualized by the top and the bottom of the bar. For example, if we take here, this is a bullish bar, this is a bearish bar, right? So in case of taking a bullish bar, you can see the opens. So which is the year the open? The market opens at this particular point, a particular certain point, and market made of reacted to the lower level somewhere and keep moving up and up, and it marked a high for the day or maybe for the time frame, and market somewhere closed. So this is all exactly to read on it. So this has been open low and closed high and made a new high and low. This is what exactly this color bar chart, which is a bullish side. And same way, vice versa, as a bearish side. The market opens in the top here and goes a little bit high, given some high levels, and came down and given a close. So this is called a bearish trend. So which is a bullish and bearish. So basically on a daily chart, or you can take for any time frame, each bar represents the high, low, open, and close on a particular time frame at a particular day. Even weekly charts also could be have a bar on each every week based on the Monday openings and Friday closings. It's based on the time frame, which time frame you're following. For example, you're following a 1 hour time frame. Obviously, within a 1 hour, what is a high, what is a low, what is open, what is a close. This is what exactly it is being defined. So bar chart also have a suitable display for the large amount of data, which also compared to the other charts, it's be easy to identify because all 4 parameters are available in the chart. One is open, low, close, and high, which also helps traders to find out how the exactly market trends, even for the lower time frame, even for the higher time frames. So this is all about like bar chart. let's move on to the candlesticks. So this is how exactly the chart looks overall. So you can see the blue lines here. We can mark whichever colors you like to go, and you can also customize the colors if you want to keep as green as a bullish and red as a bearish. You can keep on from the customized chart settings. So this is how exactly the chart looks like. So what are the green you can see, the blue you can see is all bullish. What are the red color you can see is all bit reddish. So this is all about bar. Let's move on to the next, the final one, the candlesticks. Is quite interesting chart because most of the traders usually have this charting analysis because easy to identify, easy to read, easy to understand, and also it has a lot of advantages because it's been candlesticks is originated from Japan. So it's namely called Japanese candlesticks. That's what they name it actually, because the chart is one of the most popular charting method. It's one of the it's been followed by the century. For any candlestick chart to be plotted, you need to have some parameters. As like a bar chart, you should have some parameters. This also gives you exactly the four parameters, very important parameters of opening, close, high, and low. So here in the figure, we can see there are two types are there. One I can mark as a blue, which is also can be a green, which is open here. So the market opens at this particular certain place and start moving slowly down, and again market raised to the higher level and keep moving up, and made some high, and market has closed in this level. So which has been closed. So there we can see all four parameters. One is the open, the low, the high, and the close. Exactly opposite is that when the market opens somewhere here and market given a high of like some certain points and come down like little bit and given some low and close somewhere here, which is here. So it is a bearish one. So you can see two different kind of things. So basically the three things are important in a candlesticks. One is that the body, which represent the open and the close, right? This is the body of the candle, which is we say is the body of the candle. And the wick. Wick is nothing but the top, the spike. Two spikes you can see, the top and the highs, at the bottom. So you can see this is a high spike is there. You can see a high here or low. If it is a bearish candle, we can see high in the top and the low in the bottom. And the color, you can define the color because definitely colors defines you the different shade of bullish or bearish or trend is down or up, which will help you to do that. So this candlesticks, it's a displayed information of any price movement, market price movement, which is one of the most popular components of technical analysis, because with this we are going to see some patterns also along with that, how exactly different patterns work, which helps to identify the trends. So over the time, individual candlesticks of some patterns that also traders can use to recognize a major support resistance. So this is what exactly all about today. So before we starting into it's very important to familiar yourself to know the basic about a candles, how exactly to read and everything. So these are three major kind of charts which help you to read how the market has been moved, the price movement has happened. So this is all about basics. So let's move on to the next, which is you can see this. I have shown some figures about here. This is how exactly looks overall, which is a gray, the blue color, which is bullish, the red one, which is a bearish candle. This is how exactly it looks. You can take it out. I took it from a daily chart, which shows like in a movement direction or something. So you can see one by one, like opening, the closing is low at this high. In case of bullish one, we can see this is the opening here in this candle. We can see example, there is a opening and the low both are same. That's why they can't see any wick or spikes in the candle. And when market went up and is given a high and we can close. This is how exactly. So here we can see different shapes of the candles, right? The body of the candles. So with this candle shapes, there are patterns available, like how to read it. So we are going to cover few important patterns at the end of the. So let's move on to the next now, like support. Okay, the major important thing is that two important levels for the day or the trade. It's very important because most of the traders usually follow this support resistance, because without support resistance, it's very difficult to identify the levels of the market, how much the market will reach today, what are the levels the market can bounce back, which level the market can retrace can happen. So they're very important. So two important things I have to know as a trader when you're coming to the technical or fundamental. Even a fundamental trader try to understand which level the market reach today. So that what exactly. So two things are very important today. I mean, the main major thing is that one is support. So let's have a look on support. What is exactly support? So basically, buy force of traders is strong enough to overcome the selling pressure. So basically, what do you mean support? Like it's a bottom line or bottom level of the markets. For example, market trading at one particular level. For example, take for a goal like 100, 1900. So what are the levels are there at the bottom side? So what news or what kind of impact the market can touch the levels or bounce back, or whether it's going to break down the further levels. So usually any traders are in a day or a intraday or a daily basis or weekly basis, there'll be a 3 to 4 supports they'll be kept on the markets. So they define as S1, S2, S3 or S4, something like that. So usually, mostly the buyers are more eager or curious to know about the support levels because they want to take a call or they want to take a chance to buy back in this particular levels, because it's a very important level basically, because to break that level, market need a lot of selling pressure or maybe like a lot of huge volume to break the levels. So they consider that support as a very important level. So buyer becomes a more inclined to buy. That's what I mean to say. So buyers don't want to miss out this opportunity again, because when they see the market touch S1 or S2 or S3, it had a chance, because always whenever the market touch the support level, there'll be a small bounce back. Even it can be change in trend. It depends on the market's trend and depends on market factors. So buyers always look for the support levels to buy back and the opportunity again to buy on the markets. So support does not allows hold where they decline below on the level indicators that the sellers in the market to own over the buyers. So price can be sometimes break the support. That's what I mean to say. If suppose market is trading at S1 level and market is trying to break the S1 level, it can chance to go to S2. So it depends on the how the levels are there. So in that case, it's a false break of generate, because it basically that has been broken. So it may touch S2. So keeping on that as a tracking level of support, we can start buying from S2 or S3 something, which will give you some more support or help you to take a correction market as a profit side. So this is all about support. You can see that the graph notation, see how many times in this figure, in this graph, which shows many times it has got bounced. You can see 1, 2, 3, 4, 5, 6, even year 7 sometimes. So these all plays a major role on coming for a buying side of the movement, or even your breakout levels of going further down in the markets. So this graph shows you some more idea about how exactly the support, what is the meaning of the support. So let's move on to the resistance now. So as I said, like sellers will be more interested on it rather than support. Buyers will be more interested to take a chance. Your resistance, that seller will be having more chance, because market trends keep going up, like it's R1, R2, and R3. So they get a chance to sell. They like to go for a short selling. So selling force of the traders is strong enough to overcome the buying pressure. It means at a particular point of time, the market is overbought, maybe in R1 was overbought, or maybe R2 it is overbought. So there's no further pressure is not there for the buying side. So they try to look into the selling side to be on a short selling. So sellers become more inclined to sell. So as I said, that the price can sometimes break a resistance level, but stay trading near to the level and turn back lower. In this case, a false break generators. Basically, what I mean to say, when market breaks R1, it can move to R2. If the trend is on one side and R2 to R3, let's keep moving on that way. So depend on the trend, the overall trend, or you can say depend on the news factors or other market factors scenarios, the market will be keep moving on. So if your traders has a mind that I want to do some intraday or daily trading, you have to follow these two informations on a daily basis, like resistance and supports, which really helps you to do some small trades inside, which also gives you some other like stop loss. For example, I'm saying, for example, you see that market touched R1 and you feel like there are more correction can happen in the downside. Okay, execute orders in R1 as a selling order, and you can keep R2 as your stop loss. So this way the traders can do that. And same way for the support side. If you see the markets can chance to bounce from S1 to S2, buy from S1 and keep a stop loss at S2. So this will help you. This can keep on doing, because most of the time, 75% of the time, the market will be moving on the range bound, unless there is any important news in the markets, unless you see any complete one side direction of markets. So this will help you in a longer runway. So that must to wants to take important information about resistance and supports on these markets. Let's go on to the next. So this is how exactly the graph looks. You can see here where I have shown some example in support and resist and in a support example where you can see the resistance supports here. You can see there is 1, 2, and it's third time it's been broken. So it plays an important role. So we can sell here. Maybe you're not knowing which resistance. So if we come, the market comes to this level, you might be knowing about which is the resistance level. So maybe R1, R2, we can keep a stop loss about this. So which will help you to move somehow to some extent of the profits to make. And also you'll be safer side that R2, R3, we can keep some stop loss to protect yourself from the major risk. So this is all about support and resistance. So let's move on to pivot. All right. So many are aware of this, or maybe a beginner definitely know about these things, because a pivot point techniques is a method of determining most of likely on a support resistance. That's what, because it's middle of support and resistance levels basically. So it's a very commonly used day traders, so that they are able to form a potential price range of the day. That's most important. So in your calendar, in your trade papers, or in your calculation on daily strategy, once traders has to be followed three things. One, you need to know what is a pivot level for the day or pivot level for the time frames, and also what are the resistance and support to be followed. Because the pivot point represents the level where the market direction changes during the day. For example, if a market cross the pivot level, obviously it pushing to the R1 level or R2 level. And same way, when a market is down crossing the pivot level, there are chance to reach S1 and S2 and S3. These things happens. So obviously, the main reason for the pivot point trading can be gained so much of popularity is that because it's predictive some kind of direction which breakout happens at the particular point. So how I show you some calculation how to find out pivot points is very simple. It's many softwares available, or we can say from the Google it, or even ICM has inbuilt software to identify the pivot levels on the day of the particular time frames. So here, for example, for the pivot, like you can see, high, low, close divided by 3. That is a pivot point. For example, high is like 1900, close is 1980, and the low is 1970. If you just plus addition it and divided by 3 gives a pivot point. That's a level for the day. If that level is trading above, the market trading above the level, there are more chance to touch the R1 level, R2 level, or R3 level. And same way, when a pivot market trading below the pivot level, which is like S1, S2, S3. So this is a perfect scenario. It's like markets. In case of idea behind the trading on pivot point is to be expect to reversal or breakout. This is what I expect. Right. So basically, when you touch R1, there are chance to reverse, or maybe it goes to S1, it's going to reverse. So this is what exactly is in the mind. So this help you really. As a beginner, definitely has to follow this pivot points, which will really helps to know what are the levels of the day, which is going to be impact, and which will help you to take your direction safely, and also with some proper and defined stop loss to be maintained as per your risk factors. So this is all about pivots, and I've marked here. Very easily you can see this. This is a PP, is a pivot point. Yeah. So where we can see R1, R2, and R3, and you can see S1, S2, and you can easily plot from any of the graph. You can even follow any time frame, which also gives you all the data from the closing of price and high and low and close. So you can mark this way, and you can also find out a daily what is the high and low and close, which will help you to take a decision. For example, in this case, market has been keep trading from this point like above this. So you can try to touch R1. So as you know that if our R1 level is very strong compared to the last previous data or historical data, definitely the downfall will be there to take a call on it. So this will help you really without any tension or without any kind of panic or fearless. You can be trading on easily on a daily basis, intraday basis, you can day on day. So if there is a news or any impact, suddenly market move, definitely that is very different scenario. So you have to keep following along with the trend, which also help you where to keep a stop or where to exit your positions in these cases. So this is all about pivots. Let's move on to the next retracements. So it's one of the very important topic in coming to the technical analysis, because a retracement represents a temporary reversal in a direction of price. That means if case, for example, you take a recent example of gold, last 2-3 weeks, the market is on one side. So we don't know where the market is going to head in. So there are some correction happening then and there, like, what kind of correction. So whether to buy or whether way to wait. So those, if we feel that the market is a one side direction, depends on different factors or fundamental or economic factor, that market seems looking go further upside or on a bullish trend. So whenever the market has a correction, this retracement will help you to enter again in the markets. So for example, is a bullish, there's a small correction happen, there's a chance to again enter into the market. So this is called retracement. It's very important because especially this works lot with in a trendy markets when the market is one side. So retracement and reversal should be dignified like as usual, like a short-term change within a major long-term trend, which is a reversal signal, which also gives a larger trend, which begins to the new trend. So this helps you. For example, markets moves under $50 in gold and slightly $10 correction happen. There's a chance to buy back again. There's an opportunity to buy back. And again, market moves again $50 and there's a correction happens. So this is what exactly. So while you're talking about retracements, in a retracement, which is a mainly focus on a few things, which an easy tool available on this. One major tool which available on charting on a platform in MT4 or MT4 or CChaser or any other platform, which is called Fibonacci retracements. It's one of the fantastic retracement platform tool, which you can plot yourself from the chart, and you can also identify what kind of correction happen in it, or what kind of markets corrections, which are going to help you to, take a call on the market. So based on the idea of the market, will retrace as a predictable portion of the move, after which they'll continue to move on the vertical directions. Exactly. So there is some inbuilt and proven Fibonacci series. It's been kept on the platform with the plotter along with this tool, which is called 23%, 23.6%, 38.2%, 50%, 61.8%, and 76.4%. These are the line support and resistance levels, which is kept as a ratio of any Fibonacci retracements. So, for example, if you want to make clear more to know, I plotted a graph here. For example, market has moved from here to the top to this level, and market is trading at this level or this level. So, from the platform, you can able to plot the Fibonacci retracement. There are two types are there. One is a retracement, one is extensions. But definitely we are going to see in deep about how to read the Fibonacci retracement, which level, which time you have to plot, where from that you have to plot the retracement, from which point to which point you have to plot it, so that we get the retracement level in the right way, which is going to cover it in the coming webinar. What I'm going to see today, I'm going to show exactly what are the tools available for the retracement. So I've shown an example here, where from here the market has been bounced to this level. From here you can see there are different level of corrections happening here. See 23%, 38%, 50%, 61%, and 78%. So this is how exactly you can plot yourself to identify which percent of retracement has been market is corrected. But make sure that these are very important, like 23.6, 38.2, 50%. If a market is crossing 50 or 61.8%, obviously there are more pressure on the reversal trend. If it is a bullish, definitely it's going to come down. If it is a bearish trend and you're plotting market trading around like more than 50%, 61%, because market is almost profit taken or a sell off or a buy off is happened more than 50%. Obviously, there's going to be a reversal trend in the markets. So you can plot accordingly. But for sure, we are going to come up with the different technical tools and indicators in coming webinars. So we are going to see in brief, so how to read which one is suit, which are the market to be taken, and which kind of points to be plotted along with the retracements. So here, this is all about the Fibonacci retracement today. Let's move on to the next. It's a candlesticks pattern. As I said that it's a Japanese candlestick. So there are like candlesticks patterns, or one of the technical tool, a trading tool, which have been used in centuries. You can see it from 1900, something like that. That's what they call Japanese candlesticks, especially to predict the price directions. and there are dozens of different candlesticks patterns out there. So it's very difficult to follow all the patterns because understanding the patterns are different and identifying the patterns in the chart is different, and you identify something and market has to move on as per directions. So make sure that we have a few patterns which easily you can identify and usually popular and is also frequently appears on the markets. So where I took here now for your knowledge. So I took like, let me explain. Candlesticks pattern is a technical trading tools that has been used in centuries, as I said. Again, patterns, nothing but a candlesticks, candle charts, candlesticks charts, it's at an open, high, close. Based on the body of the candle, based on the closing of the candle, based on the wick or spike of the candle, it gives the directions. The price direction will be there. So this is what exactly all about. So I had been taken some few popular candlesticks here. So we can see one is a doji. From the name you can understand it's from Japan. So doji, or we can say hammer, inverse hammer, bullish engulfing, bearish engulfing, or hanging man. Apart from this, there are many like evening star, morning star, many are there. Today, I just want to highlight only this because you like to give some more information about small basic information, how exactly. So once you're thorough about this thing, slowly you can grab yourself to understand other patterns so that you can also get some knowledge about and you can identify easily in the market. So let's start with one that's doji. So doji has a different kind. If you maybe seen where you can see that you maybe have a doubt that this we have said about candlesticks, but I can't see any body or a candle body of the candlesticks. Exactly. So here, what you see here, there are 4 types or 5 types here. You can see standard doji, long leg doji, dragonfly doji, gravestone doji, and 4 price doji, right? So you can see here, right? So these are standard doji, which nothing but this is also a candlesticks basically. What happens here, you can see the high or low or high, whatever may be the spike, but the opening and closing are same. That's why you can't see any body or we can't see any shape of the candle. It means it open at the same place and close the same place, but it's given some spike either side, which equally happen. So whenever you see this kind of direct patterns, when the market is in a downside fall, when you see this kind of pattern, definitely there will be an upside action. So this is what exactly the doji candlesticks. And if you're taking about this one, is a perfectly works for bullish side because when there is a market fall and this kind of doji formation is there, particularly, maybe we can see some small difference. Probably, maybe some few pips closing will be there. Sometime will be exactly there will be a actual open and close will be the same price. So if you see this kind of patterns, definitely market will be reversal happens. And when you say dragonfly or kind, again gravestone is also on kind, and also you can see this 4 price doji also on kind. So majorly you can see this or this or this. This 4 or regularly happens in any time frame. But looking for the larger time frame, that helps you a lot because a few lower time frame which can be due to spread or due to like heavy fluctuations or price movement, it won't give you a proper directions or proper indication. But if you're taking a more than 30-minute time frame or more than 1 hour time frame, if this kind of patterns appears in the market, definitely you can take a call because what happens here, this gives a direction as well as give a stop loss here. For example, if there's a market is a bearish trend and this formation has happened, easily you can take a call after this breaking this level and you can keep a stop loss at this lower, which will help you to save your trading as well as you can also wait for a while, which depends on the trade, So this is one of the major and popular patterns, candlesticks patterns. Let's move on to the next one, which is hammer. So from the name, you can understand, it's very easy to know, like hammer, it looks like hammer. This is what exactly the patterns looks. Whenever you see a downfall in the markets and you see a pattern like hammer kind of things, and which is green in color or blue in color, whatever maybe, it's bullish. I'm talking about the bullish in a closing. So obviously you can see the market would be like reversible, and easily we can place a stop loss here when you break this particular point of the day. For example, you take is a daily trade, daily chart, particular day, and next day if you see market is break this level, you can start buying from here and keep your stop loss at this level, and it definitely give you some more corrections on it. So this is called a hammer candlesticks pattern. It is formed a short body, small body of the long wick, long spike, which shows that the market is sell-off has been over. So they start buying up, buying pressure is there. Market is close in a higher level of buying, close near to the high. So which shows that the market is going to be continue on the same direction. That's why it shows as a hammer candlesticks. So this LP is mostly you can see in different time frame, even 30 minutes sometimes. But you should be very careful because the time frame is very less, so the closing and opening will be very fast. But if we're going to more than a 1 hour, 2 hours, 4 hours, 5 hours daily or weekly, or more effective on this kind of signals actually. So this is all about our hammer candlesticks and inverted hammer, like it's inverse hammer basically. The same way we can see when the downfall happens, and you can see this kind reversible, but it's inverse hammer, right? You can see this a small difference here. The spike is in the lower side, here the spike is upside, but anyway the result is same, like the potential of direction of the trend is going to be on other side, a reversal side, so obviously it's going on upside direction. Same pattern will happen on the reversal side also. For example, when you see that hammer is like green red in color, the top the red, and the market is in the bullish, so obviously going to come down. So it is a vice versa pattern. It's going to applicable for both bearish as well as the bullish trend. So this is all about reverse hammer. So similarly, bullish pattern is the inverted hammer. The only difference being it's the upper wick is long and while the lower wick short. That's what it means to say. The upper wick is right. So this is usually conformed. You can see many times, few times in the markets, even weekly, 1 or twice easily. But only thing to identify, first you can read it, how exactly to understand what kind of patterns it is, how the patterns looks, and what kind of pattern it is. So where to execute the patterns, that is the most important. So when you understand that, then easy to identify in a daily trade, which can help you to make some profits. So let's move on to the next, which is a bullish engulfing. From the name you can see it's a bullish. Engulfing is nothing but whenever you see the markets is completely down and you see a red or a bearish candle, and the next day candle which is engulfed, that means it has been crossed the levels and crows above that, it looks like. So there the pressure happens. This looks like a pattern which has been, the sell-off is over, the market has broken the sell-off levels of a particular day and it's been closed in the high levels, so which is gives you the bullish trend. So now if you start buying from here, that gives a trend on a bullish potential on the upside. So the bullish engulfing pattern is a form of two candlesticks. The first candle will be a short red body that is completely engulfed by the larger green candle. So that means it's been engulfed come to the previous candle. That's what they mean to say. So this is also one of the major candles patterns which regularly happens in the market, which also helpful for the time frame that starting. Always use a higher time frame is always good because to avoid the spreads, closing, and all stuff. So which also will be a very good patterns to take a call on the markets. Next, move on to the bearish engulfing, exactly opposite of bullish engulfing. So what we're seeing there is a red candle, then engulfed with the green candle. Here we can see a green candle which is engulfed with a red candle. So it is almost covered. This red candle is covered with the previous candle. There, what happens? The red candle, the green candle has been covered almost the red candle. So this was the difference. But the result is direction is a reversal direction. So bearish engulfing patterns occurs on the end of the uptrend, is almost ending of the uptrend. When the markets keep on going, you can see the end, or maybe the reversal happens in the trend. The first candle can be a small green body, which is this one, and engulfed by a suspended long red candle. It's going to continue. So once this formations happen, you can start your selling point from here. After breaking this level, you can keep on selling. You can keep on following the trend, and you can easily, we can keep a stop loss at these levels. To be on the safer side, always go with stop loss. That will help you to work on the risk management. So this is what exactly it is. So this will help you, to take a call on this. So this is all about and hanging man, which I show you the inward hammer and all stuff, right? The same way with the reversal side. So this formation can be happen. Even it can be a higher spike, even it can be a lower red candle with a lower spike. This is also stability. So this is a bullish trend, which is red formation happen. The hanging man is a bearish equivalent to the hammer, basically, which I mentioned. It has been a change shape but forms as the end of the uptrend. So when the trend is up, this kind of formation is there, or it can be reversed also. That means inverted hammer. That means if you reverse this candle, you can see a spike in the top, you can see the red in this. So this is one of the patterns. So all beautiful patterns are there in the candlesticks. So what I've shown here is just a few, but to understand, as because when you understand this thing and you implement that all in the markets and start to execution the trade based on that, that will be helpful for you. That's why I didn't want to take much on it, but definitely in a coming webinar, we're going to cover many patterns, which are the popular patterns, and also you can make use of this information, and you can try to execute yourself on your chart, identify something, which also helps. So this is all about your basic things today, and where we are trying to cover in a few minutes, where to who are beginners would like to start with the technical information, which really helps to start somewhere gradually. And upcoming webinar, we are going to go in deeply about the technicals, what are the indicators available, oscillators, or we can say something like strategy, which strategy works on it, what, as I said, that retracement, how to read the retracement, how to plot the retracement in the chart, in MT4, MT5, other platforms. So we are going to cover everything on this. So this is all about today, and hope you everyone enjoyed. And if you have any doubts, you can write or you can raise your questions. I'm happy to help you for today. Yeah, there's the one gentleman raised one question: how effective the candlestick patterns are works? Of course, like we can't say 100% always, because it's all based on the proven tools basically. But still, you have to make sure that which kind of patterns it is, what kind of pattern it is, and make sure that you try to read and experience a few times. So definitely with this experience, you'll definitely easy to identify the patterns. And with that patterns, obviously all the patterns will give you some kind of a stop loss along with spikes and everything, so where you're going to keep on the support and be able to carry on this. But you need a lot of practice, and definitely it works on a major time frame, which is what we've seen in the market, that was experience, and that was even proven. That's why we kept the candlesticks pattern has a different kind of helpful for the traders. Any more questions? Great. Thanks for joining today. Hope everyone is enjoyed. And in case of any doubts or any clarifications, you can always write to ICM. And this webinar will be also uploaded on YouTube. You can also have ideas if you want to go back to learn more about it. All right. See you again with the upcoming new webinars with the new topics. Thank you, everyone. Thank you. Have a good day. Bye-bye.